Picture this. It is a Tuesday afternoon. You had done some research, not deep research, just a quick look. And 3 months ago, you bought shares in a small company. Nothing happened for a while. And then suddenly, the stock is up 40% in a week. You didn't do anything. The market just moved. But here is what happens next. You feel brilliant, genuinely, properly brilliant. You call your friend, you tell your spouse, you maybe even mention it at a family dinner. And somewhere deep inside, a quiet thought takes root. I think I am actually good at this. That feeling, that is not confidence. That is dopamine. And that is what this episode is about. Because if you don't understand what dopamine is doing to your brain, you are going to pay for it. Quietly, consistently, and for years. This is module 1 of the Behavioral Finance series. We have already looked at how the amygdala hijacks your decisions in a crash, how ancestral wiring makes you buy high and sell low, and how cortisol physically shuts down your ability to think long term. This episode takes the other side of that coin, not the fear chemical, but the reward chemical. And it turns out the reward chemical is just as dangerous, maybe more so, because it feels fantastic while it's destroying your portfolio. So now here is the myth most investors carry into a market. A winning trade proves you have an edge. But here is the reality. A winning trade proves your dopamine system is working perfectly. These are not the same thing, but inside your skull, in the moment, they feel identical. Neuroscientists have known for decades that the brain's reward circuit, specifically a structure called the nucleus accumbens, fires dopamine, not when you receive a reward, but when you predict one. The moment you spot a hot stock and your mind starts running the numbers of what it could be worth, you are already high. The trade hasn't happened yet. And here is what that means for every investor who has ever felt certain about an exciting idea. The certainty you feel is not evidence that you are right. It is the evidence that your dopamine is flowing. That distinction between genuine conviction and neurochemical excitement is the entire subject of this episode. Everything we build after this depends on understanding it. Now let me take you to an Indian wedding. The first gulab jamun is wonderful. The second is also very good. But by the fifth, you are still eating. Not because you are hungry, but because you cannot stop. The sweetness itself has become the driver. Dopamine works exactly like this. It is not the reward itself. It is the anticipation of the reward. And once your brain gets a taste of a winning trade, it starts chasing that feeling again and again, again and again. The problem is that your brain does not distinguish between skill and luck. It just knows it felt good and it wants more. Now bring this back to your Demat account. You made 40% in 2 months. Your brain logged the experience. It didn't note the market conditions that produced that outcome. It didn't note the element of randomness. It noted only one thing. Doing that felt great. Let's do it again, and this time bigger. That is the neurochemistry of a winning trade. And it is one of the most expensive chemical reactions in the human body. Once you understand the 4 stages of dopamine loop, you will recognize it everywhere in your own investing behavior. Stage 1, the trigger. You see a tip, a news headline, a friend's story about a multi-bagger, dopamine starts flowing before you have done a single second of a research. Stage 2, the anticipation. You research or sometimes skip it entirely. The dopamine continues. Every piece of confirming information feels like a signal. Contradicting information barely registers. Stage 3, the hit. The trade wins. Your brain gets the full dopamine reward. It logs this pattern deeply and it marks the entire sequence, tip, excitement, action, win, as the one thing to repeat. Stage 4, the chase. Your brain now hunts for the next trigger. It quietly increases your risk tolerance because it wants the same hit or a bigger one. You start taking positions you would have passed on 6 months ago. And here is the cruel part. When the trade loses, your brain doesn't simply forget the previous wins. It rationalizes. That was different. The next one will work. This is not a weakness. This is not a character flaw. This is biology doing its job in the wrong environment. Here is something important about the asymmetry between winning and losing. Dopamine is not symmetric with loss. The anticipation of a gain produces a strong dopamine response, the experience of a loss produces a cortisol response, a completely different hormone with completely different effect. Cortisol narrows your thinking. It makes you reactive, not analytical. We covered this in full in the cortisol episode. How stress physically limits the function of your prefrontal cortex. So the asymmetry is brutal. Dopamine makes you overconfident after wins. Cortisol makes you irrational after losses. The market doesn't need to do anything extraordinary to derail you. Our own neurochemistry does the job. Two chemicals, one portfolio. And neither of them has read your investment policy statement. Let me make this concrete. Imagine you invested 5 lakh rupees in a mid-cap stock based on a hot tip. It went up 35% in 2 months. You made 1,75,000 rupees. Absolutely, the dopamine hit was enormous. Riding that confidence, you put 8 lakh rupees into the next idea. Slightly riskier, but you felt certain about it. This one felt 28%. You lost 2,24,000 rupees. Net result, you are down 49,000 rupees. But here is the psychology. Most investors remember the 35% win far more vividly than the 28% loss. They remember how it felt, and so they go again. The real cost of dopamine-driven investing is not any single bad trade. It is the compounding effect of systematically increasing position sizes after wins and losing discipline after losses. A landmark study by Barber at Orion found that the most active traders underperformed the least active traders by nearly 6.5% per year. Not because they were less intelligent, because they traded more. And trading more is often the direct result of a dopamine loop that was never interrupted. In India, this played out in plain sight between 2020 and 2021. New demat accounts opened at a record pace. People who had never invested before were making money. The dopamine was flowing everywhere. And then came the correction. Those who entered late, driven by FOMO and the dopamine of watching others win, took the full loss, while the disciplined investors had already been following their rebalancing protocol. The market didn't do that. The dopamine loop did. This loop shows up in 3 specific patterns that most Indian investors will recognize in themselves. The first is the multi-bagger memory. You caught one stock that went up 200%. You think about it often. You use it as a proof you can do it again. You don't think about the 6 stocks that went sideways or down in the same period. Dopamine made the win memorable. Nothing reinforced the losses the same way. The second is overtrading after a run. When you have had 3 or 4 good trades in a row, your risk tolerance quietly expands. You start putting money into ideas you would have normally passed on. This is the dopamine loop telling you you are on a hot streak. Streaks feel real. In financial markets, they are mostly noise. And the third is revenge trading. After a loss, instead of pausing, you immediately look for the next trade to recover. The urgency feels like conviction. It is not. It is dopamine-deprived brain seeking to return to its previous state of reward. The goal is not to eliminate emotion from investing. That is impossible and not even desirable. The goal is to create distance between emotional signal and the financial decision. Here is what practically works. Rule 1. Keep a decision journal. Before you enter any trade, write down why you are entering it. What is the thesis? What would prove you wrong? What is the exit level? This 60-second habit forces your prefrontal cortex back into the conversation and overrides the dopamine-driven impulse. Rule number 2. Institute a 48-hour rule for non-systematic buys. If it is not part of your existing SIP or rebalancing plan, you do not act on it for 48 hours. Most dopamine-driven impulses fade within 24 hours. The ones that survive 48 hours are actually worth examining. Rule number 3. Never increase your position size after a win. This is counterintuitive. The winning feels like momentum. It is not. Your position sizing should be driven by your conviction in the analysis and not by the emotional memory of the last win. Rule number 4. Track your wins and losses with equal weight. For every winning trade you review a losing one alongside it. This is how you build a realistic self-image as an investor, not the one that dopamine is trying to construct for you. Rule number 5. Name the feeling before you act. Literally say to yourself, I am excited about this trade. Naming the emotion activates your prefrontal cortex and interrupts the automatic dopamine response. UCLA research shows this measurably reduces the emotional hijack. It sounds simple and it really works. The seasoned investor is not someone who has no dopamine response. They have the same brain you do. The difference is that they have built systems, a checklist, a journal, a 48-hour rule that put a wall between the chemical hit and the capital allocation. Think of the last trade that excited you, the one where you acted quickly and felt certain. Ask yourself, was that certainty driven by your analysis or by the way it felt to imagine it going up? The market will always produce exciting stories. A new sector, a new disruptive company, a government policy that seems to favor one industry, and each time the same chemical process will start in your brain. Anticipation, excitement, and the urge to act. The market rewards discipline, not excitement. Your dopamine does not know the difference, but your portfolio will. Given that we are all wired this way, running the same neurochemical loop every time a hot idea appears, how do we invest intelligently anyway? That is the question this series exists to answer. See you in the next one.